The best of Money Matters.
Market View on Money FM 89.3.
Hi, I'm Willie Keng. You are listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch. Asia Pacific markets soared this morning as investors heaved a sigh of relief after President Donald Trump hit his pause on reciprocal tariffs on US partner countries. The decision came after he said investors were jumping a little bit out of line as markets collapsed and US Treasuries were showing signs of crack in the world's largest economy. The 10-year US Treasury yield was last traded 4.3% after rising overnight above 4.5%. Now in the region, China's consumer prices contracted for a second straight month, with its producer price deflation worsened as Chinese exporters struggled amidst an escalating trade war. What do we make of use of these situations? Let's unpack all of these developments with David Chow, Director at Azure Capital. Welcome to the show, David.
Hi, Willie. Hi, everyone. Happy Thursday.
Yeah, happy Thursday. Let's jump right in here, David.
Okay.
Earlier this morning, the Straits Times Index rallied close to 9% shortly after the market opened. So far, David, how has the STI fared so far for today, and what is driving markets?
I think, given that the market opened so strongly today, I think there's bound to be some profit taking off the tables, especially from investors, who bought into the market, perhaps at the close of yesterday's. So it's, I think it's perfectly normal to see, some pullbacks in the market, especially, even as we are speaking, the US equity, the US futures have also been pulling back. So with that being said, it's normal to have the market rallied, 9%, and then paring its gains to close at 5% today. So if you are asking, what is driving the market so far, well, I guess it's still Trump. I think it's a very much welcome decision, for him to pause tariffs for 90 days. But with him, you will never know. I suppose in the near term, the market will still remain jittery, but hopefully just a tiny mini bit less so. We are certainly not taking a lot of comfort in this still. And if you're looking at some of the biggest movers in the sectors, no big surprises here. It's a green day today. We should expect STI index component stocks to be featured, prominently in the top gainers list, and some of them do, like the local banks, property counters, venture capitals, Jardine. They're all in the top gainers list today. So as I've said, it really makes one wonder, how long can this rally last? And looking at the futures now, as I was saying, it's down between 1.2 to 2%, which is normal considering the three big US key indexes rally 8 to 12% overnight. Going forward, I guess we can still expect episodes like this to occur. We can have a bad day down anywhere. The market can be down between 5 to 10%, and then it can rally a few percent next day because of some good news, and then we can always revert to a downtrend soon after.
Right. Speaking of choppy markets, like you've mentioned, I like the way you put it. Green day today. If we see some corporate news, ST Engineering shares have been a blistering performance. It has hit about 41% year to date. I'm just want to get your views here on ST Engineering. What's driving share price performance recently, and sort of buckled the trend against the post-tariff sell-off?
That's right. I've met up with my fellow peers and other investors who have expressed disappointment that they didn't buy into ST Engineering in late February and be part of the year-to-date rally at that time of 48% just before April 2nd. So after April 2nd, if you look at the stock chart, I think the stock went down as high as 10%, but quickly regained losses, and today we have it rebound at about 8%, closed at somewhere around 660. I suppose the entire tariff saga didn't seem to have discounted badly, and as this is one of those defensive stocks among the STI component stocks, due to it being a proxy or being perceived as a proxy for defense spending, and because of all this geopolitical tension that is happening, all the time, especially, potentially even more now. So, but this is not all that ST Engineering does. It's also a leading maintenance, repair, and overhaul, or otherwise called MRO company, and it actually plays a key role in servicing many popular aircraft models such as your Airbus A330, A321, A320, etc. And besides expanding, this hangar capacity, the company also sees the securitization of related aircraft, engines, and other critical parts as its next bout of growth for the commercial, aerospace segment. So as we see, aviation traffic recovering back to pre-pandemic levels, the growing demand for capacity, plus the capital needed to deploy and maintain assets means that this business, will continue to garner interest again, hopefully. And if you recall, this ST Engineering, they actually had an investor day on March the 18th, where management, reiterate, their visions to earn a revenue of at least 17 billion by the year FY29. Fiscal year 2029. And if you recall, at the end of for the whole year 2024, their revenue was actually about 11.3 billion. So if we just put these two targets in perspective, we are looking at a CAGR growth of about annual revenue growth rate of I think about 8.5%. That's fairly high for a big company like ST, because we know as a company grows bigger, it tends to find it harder to grow. And I think in addition to the financial targets, this revenue guidance, the company has also laid down a clear dividend policy that promises a higher payout. In addition to the 18 cents to be paid out for FY25, and the FY26 dividend will also include a variable component of about 1/3 of the earning growth generated that year. So a lot seems to be on the cards for them. And last but not least, there's also possibility of M&A, as I mentioned, in the MRO space for them. So as the company continues to establish itself, not only as a global defense stock and MRO company, which means more businesses and revenue streaming from international contracts. I guess investors will have to be mindful that as it's gaining more exposure to global dynamics, the tariff could affect them in certain economies. So this is something which investors should be aware of. But at this point in time, I think it's too early to tell what the impact of tariffs will be on the group's business. But do be mindful that 30% of group revenue is generated from the US.
Following from what you have mentioned, ST Engineering seems to be on its path after the COVID-19 pandemic, and I think tariff, like you have mentioned, is one of the concerns. Do you think there are other fundamental challenges ahead for ST Engineering? Being the one of Asia's leading defense contractors, like what you have mentioned.
I guess it's how they actually manage relationships with their customers. Because as far as I'm concerned, every time their customers, put up a bid, you will see, their international, other big defense companies, also coming to play. So, a lot of times I've been, sometimes when I see some of the investor relations of the company, I will ask, how do they actually manage relationships, vis-a-vis their peers in the industry.
Right.
So, this is something that, we have to figure out, what makes, their customers choose ST Engineering, products over the others. I guess this is key. And the second part is, since they are looking for M&A targets, I suppose this is one of the things that investors will have to be mindful of, whether they will be able to acquire so-called the right company at the right price.
I like that phrase, right company at the right price. Moving from corporate news here, I want to touch on another asset class, which is treasuries. We are seeing sell-off in treasuries earlier this week. 10-year US Treasury yield was last traded 4.3% after rising overnight above 4.5%. David, I just want to get your views here on the recent moves, and what do you think is driving yields here?
Okay, I'm really hoping to say that 4.3 is nothing compared to earlier in the year, we have seen yields reaching as high as 4.8%.
Yeah.
But fortunately, I can't say that now with all the tariffs, effects of the tariffs and investors, the souring of the investor sentiment kicking in. So I think what we can be sure of is that a rising bond yield will mean higher cost for companies to borrow, and of course the U.S. government too, as they are running a super high twin deficit as we know. So usually bonds should do well in terms of turmoil like this, as investors choose to fly to safety assets, and Trump's trade war right now is certainly undermining the U.S. debt market. So while interest rate on U.S. government debts, rose, the price of the bonds themselves fell as demand weakened due to investors offloading them, and now we actually see the real possibility of an erosion of bonds being perceived as a safe haven. So this is a big something to watch out for,
right.
And so. For that, I mean, if the U.S. bond is not seen as a safe haven asset anymore, then this will really be a big major issues. And for that, if that were to happen or almost happen, we see that the U.S. Fed Reserve could be forced to step in, with emergency purchases of U.S. Treasuries to stabilize the bond market. We are hoping they will not need to venture into this step, but we never know. As we are now entering into uncharted territory, and it's really hard to predict, how markets will react in the coming days, as currently the bond market clearly suggested investors had lost faith in U.S. assets.
Yep. Moving into the region, China's consumer prices declined for the second straight month. We have the country's producer deflation also deepening 2.5% in March from a year earlier. David, what's your view on China's CPI falling and the impact of tariffs on its inflation data?
Right. I think with release of this news, I was looking at how the yuan, the onshore yuan and the offshore yuan actually reacted. While it's now like a near multi-decade lows at 7.3469 per dollar, or for the onshore yuan, and for the offshore, it also weakened significantly to 7.36 around that level on the dollar. So certainly, this currency reacted, negatively to the economic data, especially so as I think economists who had previously been had expected a flat reading compared to the same period last year. And not only the CPI fall, but we also see PPI as well. And for PPI in particular, we think can fall further in the coming months as Chinese exporter brace for more pain, amid this escalating trade war with the US. And back to CPI, even when if we strip out if you look at core inflation, we strip out volatile food and fuel prices, it actually rose 0.5%, rebounding from a drop of 0.1% in February, although it's still lower than the 0.6% growth that we've seen in January. So for that, I think we are going to see a divergence between your CPI prices and producer prices, as your core consumer prices have shown signs of a slight pickup, while producer prices are set to deteriorate given as I said, trade disruption. So this could again, signal a potential inflection point, driven by your policy stimulus measures, in particularly, initiatives aimed at boosting consumption. While we see, recent policy commitments to really curb aggressive price cutting and additional strategies to encourage household spending, there's a possibility that we can see that core CPI numbers to exhibit further signs of a gradual recovery in the coming months. But again, the more important data also could be seen in the producer prices, and we sort of expect this deflationary pressure to persist. So I guess China must really focus on domestic demand, given the possibility of new shocks to overseas demand. And as we all know, they have signaled a willingness to do so. So we shall see what happens in the coming months.
Yeah, I mean, if you see the China stock rally, we have seen China stocks rebounded pretty strongly, with Shanghai Composite gaining more than 1%. We have Hong Kong also rallied more than 4% as well. David, what do you think has to happen for this rally to sustain itself here?
I mean, the best reason, or the best outcome would be that the US and China could manage to settle this peacefully. Yeah, that is of course the wish list on every China Hong Kong investors. But before that happens, we expect the market, of course, to stay volatile in the very near term, as we see tensions continue to escalate further before something tangible, could be discussed. Especially in my previous interview, the room for mitigating trade issues between the two countries actually seem quite limited. And previously, we have also highlighted other potential risks, including possible U.S. restriction on investment in Chinese assets. And so we think the market may continue to price in really heightened geopolitical tensions. And looking at the index itself, on the Hong Kong market, the market is really rapidly pricing in the tail risk, stemming from escalating tensions and the potential for, of course, a global recession. In our own, calculation of risk premium, we saw that hitting as high as 7.2% just on Monday. So if we take trade war 1.0 as a reference, but it's not really as a reference because, as I've said, trade war 1.0 is just China versus US, but now it's US against the world. We see, trade tension, in 2019 hitting as high as 8.3%. So we think that there's a likelihood that this level may be surpassed, if trade tensions continue to escalate. At the time, I think the Hang Seng Index may also test the 18,200 level, and I guess we believe the sentiment has the potential to really push the Hang Seng Index to this level.
We have been speaking with David Chow, director at Azure Capital. Thank you so much for your insight, David.
Thanks.
Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.